Today is July 10th, and you see the handy dandy whiteboard behind me. We are going to be walking through what the discretionary income formula is and what's the difference between prior repayment plans and the SAVE program and why it makes the payments more affordable. I have been requested by multiple people to make this video, so if you find this helpful, those that are numbers oriented or want to know how your payments are calculated so that you can double check your student loan servicer to make sure your payment is right, this video is for you. Before I dive into that, I would like to talk very quickly about this week's news updates. And really, there's always like some type of news with student loans happening recently, with it being election year and younger borrowers caring about student loan payments. It's a contentious issue because Biden's doing what he can to roll out a lower payment for more borrowers, and of course, Republican-led states. The most recent news is that Alaska, South Carolina, and Texas are put an emergency filing in to halt the reduction of payments even more for the SAVE program. 4 million people already have $0 payments per month. So 3 Republican states are trying to halt the ultimate rollout of SAVE in terms of enrolling more people into $0 payments and forgiving more debt. So I just wanted to update with that news. And now let's get to the discretionary income formula. So what is the discretionary income formula? It's the formula that is determine what your student loan payment is per month. So we're going to dive in and we're going to talk about what's the difference between prior plans that make it more affordable on SAVE relative to prior calculations of discretionary income, okay? So I'm going to be facing the whiteboard here for parts of the video. Just bear with me. Let's talk about like the current pay-as-you-earn plan. I'm just going to lift my camera here. You're going to come with me. Let's talk about the former pay-as-you-earn plan. So I'll use pay-as-you-earn right here. The key difference is the adjusted gross income is minus 150% of poverty, of federal poverty. I'm just going to abbreviate federal poverty, right? This is an annual, and I'll use actual numbers. So right here, I don't know, it's kind of hard to see. Minus annual poverty, you get this amount. And then you're going to take whatever amount this is. Let's say this amount is X, and then we'll use real numbers. This number is X. It's going to be times by, like for example, pay as you earn is 10%. If it is Parent Plus loans, it's 20%. This is why the new drop in payments this coming July by the president, having undergrad loans only be 5%, is huge, is because instead of 10 for pay as you earn or 20 for Parent Plus loans on ICR, it's 5% for undergrad loans. And that's what makes the formula even less. So it's 10%, and then you'll get a number here. So now let's use some real numbers. Let's say somebody's adjusted gross income is, let's just say it's $70,000, okay? The poverty line, let's say, and the poverty line also depends on your family size. So let's say I'm a family size of 4, and the poverty line for family size of 4 is $31,200. You see that? $31,200. But because it's 150% in pay as you earn, we're going to be timesing by 150%, okay? Let's see what that number is. I'm going to pull up a calculator here. So we're using $70,000, which you see right here. I'm going to use a calculator just to make my life a little bit easier. $70,000 minus 150% of times 31,200 will come to this amount right here. 70,000 minus 150% of 31,000 comes to $23,200. I'm going to set down the camera Let me double check. 200 times 150% is 46,800 minus 70,000. And the adjusted gross income, by the way, you can get on your taxes. So again, is 23,200, right? And then this right here is what makes this 10% is what makes save better overall, because pay as you earn is 10. So for undergrad loans, that's 5% for save. So, but let me do this first, times 10%, 1 second, times 10% is this, obviously that's a pretty easy percent, right? So you're thinking equals $2,320. Well, that's the annual payment. So then you're going to divide this by 12. Divided by 12 gives a payment of $193.33 a month. That is the student loan payment for somebody on pay as you earn with a 10% of 150% of poverty. Their monthly payment is $193. Now, let's pretend all of this person's loans are undergrad. And by the way, do you notice the formula? It does not take into account at all what someone actually borrows. It only takes into account, based on the federal poverty, what someone can afford. So now let's talk about this same scenario, but we are going to be doing it for the SAVE program, okay? And I did start to talk about the differences slightly. But for the SAVE program, again, the core differences in the SAVE program, I'm going to get a different color marker here so I can point out the differences. And I will be doing the calculation as well. Let me get a blue marker here. I'm in my office space. So the key differences that I'm going to note on the blue marker is going to be, again, this 150% poverty and this 10%. Those are the biggest difference in the SAVE formula. And if you have questions on the Parent Plus formula, I can do this for the Parent Plus as well. But basically, for SAVE, what it's going to be is, it's going to be, again, adjusted gross income. Instead of 150, it's going to be 225% of poverty, right? And it's going to be, again, I'm assuming undergrad loans, it's going to be 5% instead of 10%. That's the formula difference. So let's actually compare numbers with the person earning the same amount of money. Again, I'm going to bring the camera a little closer. So we're going to say this person still earns $70,000 minus, this time we're going to be doing 225% of, let's say they still obviously have a family size of 4, which that's the federal poverty for the family size of 4. What does that equate to? Let's take our handy dandy calculator and calculate it. Okay, so 225% of 31,200 is 70, this right here is 70,200. So this is actually higher than how much they earn, right? Since 70,000 is higher than 70,200, then this right here would equate a $0 payment because the federal poverty is already higher than this person based on their dependency status of 31,000. So this is how you get a payment of $0, okay? Let's say this person had higher income. So this is how you compare. This is a huge 193 versus 0, okay? That's a huge difference. You can get the federal poverty line on the USDA website. Yeah, you can get the federal poverty line there. And then you basically times by 225 instead of 150 minus the adjusted gross income on your tax return. Depending on the year, you get it on different line items. If there's any amount left over, you would take it and divide, and you would times it by 5%. Again, if it's undergrad loans, if it's grad school loans, it's still 10%. But that is how the SAVE formula ends up being more affordable, because it's multiplying by a higher percentage of the poverty line, as well as it requires a lower percentage of whatever's left over. So let's say that there was an amount left over. Let's say this still had an amount left over. Instead of timesing by 10%, it's times by 5%, which yields a lower monthly payment. I hope that makes sense. I hope that makes sense. That is why the Republicans are trying to file legislation, emergency legislation, to halt the passing of 5% for undergrad loans, because that's going to lower payments even further, and more people will get $0 payments. The formula was changed under SAVE to make the program more affordable, in recognition that the amount that families are not paying towards their student loans is going to pay for higher costs of living because inflation and other items. So from everything I've read, the Department of Ed has the authority to change any income-driven program, and that there's very little the Supreme Court can do, because the Department of Education is granted the authority to manage, control, and oversee all the student loan programs. It's not wiping out, for those who are confused, it's not wiping out debt outright. People still have to qualify yearly based on their income, and they still have to commit to making a certain number of payments. For those who are confused, $0 payments does have a mortgage impact, because not every mortgage type allows for $0 payments. So I wanted to make that point clear as well. Let me know if you have any further questions about the discretionary income formula, and happy to answer them. Please like, subscribe, and share with those whom you think this information would be helpful.